25 years ago, when Putin first became president, 5 terms later, at the time, China had just passed Italy in terms of GDP.
Oh, wow.
And I guess Britney Spears was topping the pop charts, to put it in perspective for timing. But a lot's gone on since then. But what's fascinating is how much stronger Putin is today and how much weaker the Russian economy is from back then. It's moved from outside the top 10 economies during that period. I think it's 11th or 12th now in purchasing power parity. So just fascinating to think he's had 25 years of, some would argue, destroying a nation and destroying other nations at the same time.
That was a prepared fun fact, wasn't it? Or did you just have it in your mind?
No, it was
Okay.
Russia's been on my mind. So
Okay.
I have a possible topic for next week for that. So the other thing that's really troubling is the water temperature, ocean temperatures, which have hit records almost every day this year, I believe. And I think for the last 9 months have hit new records, and that is not good for the system. So I think there's more volatile weather and more problems coming with that, which actually does impact the inflation discussion.
So Jacques Cousteau's, or Fabian Cousteau's, Lisa Marchino will be here tomorrow.
Interested to see, because it's got to be ruining the ocean life and the corals. So we're good to go, 11:01. So a lot going on in the central bank area this week and today. Japan just announced that they've moved out of negative interest rates. I'm not sure for how long it's been, but certainly they're among the last to pull out of negative interest rates. You had the Fed meeting today and tomorrow, which we'll talk about. The Royal Bank of Australia kept rates flat today. And really the market since the December Fed meeting has been really trying to figure out this disconnect between the market's 7 rate cuts back in December and where the Fed was, which was in the dot plots, which was 3. And I think a big part of that was the disconnect that people don't understand what the dot plots represent versus what the market's desire for getting multiple expansion to keep the market moving up was going on. I think we're at a point now where the market needs to digest a major move. It's up, I think the S&P is up 45% since October of 22. So a pretty significant move up. And even just since December, we've had massive moves in the markets where a lot of markets are hitting new highs, but the economies are struggling. And I think even in the US, which is one of the better economies, we're still looking at, really 2 to 3% growth, which isn't all that great. So I think the market's come around to the Fed's point of view of they're not going to get their 7 rate cuts. And there's certainly the issue is they thought back in December they were going to have 7 rate cuts this year, and the first one was going to be in March. I think Powell has pretty much said he's not going to be raising rates, but I don't think they'll be looking at rate hikes until May or June. So we'll touch on that. So for all the talk about the central banks and what they've had going on this year, this chart shows you that there hasn't been all that much movement. So the yellow is rate hikes by central banks this year, and the blue is rate cuts. And what you can see is, for the most part, there's been very little changes in rates because the central banks felt that they were either in the West getting close to where they needed to go in rate hikes. So it looks like rate hikes are pretty much off the table, but how fast they were to cut rates is what's been troubling the markets. This week, we have all these central banks making decisions. So a couple have already gone off with Bank of Japan and Royal Bank of Australia that I just mentioned. But you are seeing a lot. This is a major part of the global economy having rate announcements this week of some sort. And what's creating problems is a couple weeks ago, we thought it was a straight shot to significant rate cuts and that the Fed was going to get back to their 2% target. And then we had some surprising numbers in employment, and then the core CPI and PPI surprised to the upside. And we got basically a 3.9% number on the core CPI. And energy has been coming down. So we know that a lot of the other costs are being troubling. We'll touch on that in a minute. But this was not helping the case for the market to have the Fed move more quickly. So they know that there's more to come. And in fact, actually today, the Bank of International Settlements head, August Carstens, was out saying that he's cautioning all the central banks to be careful about cutting too soon and finishing off the inflation fight. So he's just today expressed concern about the last mile. And this is flowing through into other areas. So this is the New York Fed inflation expectations. And for the median for the 1 year, it stayed around 3%. But for the 3 year, it ticked up to about 2.7 from 2.4. And on the 5 year, it jumped to 2.9%. So that's not trending the right way. And that leads to some other issues. But this is a Bloomberg survey of economists, and when you think about what they're seeing Fed funds rates gradually coming down. They're seeing growth stuck around 2 or 3%, just under 2%. They're seeing the unemployment rate stay pretty steady, or just over 4%, but PC slowly coming down and core PC coming down as well to their targets. But it's not really, this is what the market's saying. It's kind of what the market's hoping. But you're seeing other challenges going on for the central banks. And part of the reason the BIS was saying don't jump to the conclusions that were done is Japan just had the largest wage hike in 30 years. I think it was 5.9 or 5.9% hike or 4.9% hike. You're seeing, I mentioned this in the past, but the Boeing mechanics union is up for their negotiations. The flight attendants union, 16,000 up for their negotiations, and the German auto workers are up for their negotiations. All those are looking for 20 to 40% increases, and that pushes other non-union workers to look for more increases as well. But it's not just inflation that's the problem and the real issue, and this is the disconnect between politicians and the markets, is the cost of living issue. And you can see this this is just grocery prices against overall prices, and they're moving at a faster rate. You think about other prices, and these are the concerns that consumers have. And it's groceries, it's gasoline, it's rent and housing, which we know has been a problem. Restaurants and meals are getting prohibitive to go out, and then clothing is going up as well. And that's not even counting the insurance costs, which anyone who's had as part of a condo association that went for their policy renewals, or you went for an auto renewal on your policy, you're seeing massive increases if you're getting renewed at all. So cost of living is going up, and that's changing consumer behavior. And when consumer behavior pulls in, you start to see companies react to that too. So if consumers are worried about prices and alter their spending habits, then companies alter their habits, both for hiring and CapEx. And so the sentiment doesn't create a slowdown. It's the behavior that comes out of the sentiment that can create a recession. We're not calling for one, but this is something we have to be careful about. If the consumer behavior changes and corporate behavior changes, you have to be careful. And small business behavior is very different than what you're reading about with the FANGs and the mega cap stocks. They're looking at very different problems right now. And we're seeing that in the venture community. We're seeing that in the private equity area. And you're seeing that in public markets and small caps as well. There's a big disparity to how they're seeing the world and how Microsoft is seeing the world today. But the market has finally come around to the Fed's view on where rate cuts might be. They were looking at 7 cuts, 175 basis points not too long ago. Now we're back down to where really it's looking at 75 or 76 basis points, I think is where they're looking at on Bloomberg right now. So not an unreasonable level. The Fed may or may not do that. They may not do it as fast, but don't think an election year is going to stop the Fed from moving. Powell's already been told that if Trump wins, he's not going to get reappointed, so he doesn't care about trying to impress him. And I don't think Powell's ever really acted politically. I think he's always acted in what he feels is the best interest of the country when he's working. So I would expect that there will be rate cuts. There could be one the day after the election. There's a Fed meeting that day, but seeing rate cuts coming this year was not unreasonable. However, there's not a real rush for the Fed to cut right now. And the reason for that is GDP is quite strong. And just going back to the chart here, what the market's projecting, they're not looking at a bad economic outlook. This is a pretty healthy economic outlook, which you don't cut rates into necessarily. You have to see some kind of strain to make them push, or else you'll cut too soon and foster higher interest rates. And that's what they're trying to avoid. So this is where the Bloomberg survey of economists are looking at. And again, it's very consistent with, 3 cuts this year, 75 basis points of cuts. Not a lot of change from the December survey, although in the out years, the cuts won't be quite as aggressive. And I think that's really the change for next year and the latter part of this year. So the question is, are we going to have a recession or not? And this is fascinating when you think back 4 or 5 months ago, it was absolutely a recession. Then it's, well, maybe we're going to have a soft landing. And now you're looking at very big odds for a soft landing, low odds for a recession, or a hard landing, not a recession. Still, this is a pretty healthy environment that I think people are struggling with the gaps between the haves and have-nots and how that's playing out and why there's a fear in the central bank's mind of how fast consumer behavior can change and how fast business spending can change. And while we've had massive support from the fiscal policy and CapEx has been rising and corporate profits have been good, the fragility of the system could make it change pretty quickly. And I think that's really where the central banks are worried about. Although Lagarde and Powell have both said that June looks like a time they can really look at rate cuts. So this is one of those scenarios where I think your expectations have to get really back in line. The market's gotten a little ahead of itself so that you can see a kind of a consolidation period before you see a move up again. But this is a pretty healthy overall economy with some real pockets of weakness, whether it's the China problems, what's going on in Germany and other parts of Europe. But you're also seeing some really positive signs in other places in Europe as well. I think this really gets down to a company by company and a country by country basis that you really want to look. Because overall, we have slow growth, slowing inflation, and a soft landing outlook overall. But if you're in Cuba, where they're struggling to find food, or Yemen or Somalia, where we know the economic outlook is dreadful, or parts of Africa that are really struggling, and then you see parts of the developed world having very different outlooks, whether it's Pakistan or India, or you just go around the world, it's very, very bifurcated. So I think this becomes very much a stock and country selection market, whether in the public or the private elements doesn't really matter. I think the setup supports that the central banks are not really offsides on policy, given where the economy is. I think the market had hopes for better multiple expansion, but it's going to come down to how earnings go from here. I think the central banks are confident enough to start talking about taking action on lowering rates, particularly the developed central banks. And you're seeing that today with the Bank of Japan. You will see it next quarter with the Fed and the ECB. But I think you're also seeing China doing what they can to put a floor in, but they have a big fight to get through there. And I think Europe needs to get their industrial policies to counter the Inflation Reduction Act and other policies of the US and China to get their competitiveness back on track. But it's going to be a bouncy ride, but really focus on the pockets of opportunity. And I would say watch the heavily indebted companies in this environment, because rates are going to, if they don't come down quickly, I think the way to think about it is we were talking about higher for longer. I would just say it's now high for longer is the way you should think about it, because I don't think rates are going to go up much from here, but it's going to feel high relative to where we've been. And I think that's one of the big challenges that the consumers are facing is they're seeing inflation come down, but their cost of living is staying high and their cost for buying stuff is high, but they're not getting the benefit of when rates move up, when you have hikes, cycles, typically the people who are savers benefit big from that because the hikes go faster than the cost of living that you're facing. That's not happening right now, and that's putting greater strains on the system and why you're seeing so many frustrations from populations around the world. So not a negative, not a positive environment. I think we're in one of those pauses that you need to consolidate and get the expectations aligned so you can move forward from here. And I think that's where we are today. So I'll stop there, Mark, and open up for discussion.
Great, thank you again, Stephen. So, questions, comments? Agree, disagree? Where's Rob Colorado?
Stephen, when you we did this last week too, the Japan chart, and people are making, sort of news out of the Japanese market hitting new highs. And I don't think people realize that the yen has depreciated.
Why?
I muted him. Keep going.
I was saying the yen's depreciated over 35%. So if you had put your money in Japan, and then you decided you wanted to take it out today, you're doing a little better than breaking even. And so Japanese going from negative or zero rates in 10-year to almost nothing. This has happened before. We're raising rates from zero to slightly non-zero. So
Yeah.
do you think that this is actually news, or I mean, from a material sense, or not?
I think it's news that they're getting their economy to start moving, but I think I don't think it's as big a deal. I think the issue you touched on is a fascinating one, that you have a lot of stock markets up quite a bit on economies that are really doing badly. And I think that's the fragility that we're talking about, is you had pent up interest and you had some buying from the government there as well, supporting the equities. I think their underlying economy is really the issue, and I think it's still weak. I think but it isn't. They're doing some things that they're benefiting from some of the reshoring away from China. So it's a mixed picture, I would say at best. But I don't think it's as big a deal as the headline. No.
Yeah, and the stock market in U.S. dollars has gone almost nowhere. But
Yeah.
Adam?
Stephen, thank you for the presentation. How does the Fed balance the upward inflation pressures that are going to come as a result of the wage increases, with all of these unions negotiating substantial wage increases, and the stubborn cost of living being so high? How do they balance that?
Well, they can't do anything about the cost of living.
Right.
And that's a reflection of the inflation that's already occurred. So they can only focus on what they can control. So their focus is on overall price stability and full employment. And that's really it. So they're doing what they feel they can there. I think really gets to how well can companies increase the wages and maintain their margins. I think that's really what we're going to be faced with, is who can preserve margins and continue to grow, and who has to retrench. I think that's where you get a very bifurcated market.
Stephen?
Thank you.
Well,
Basic question. If the Fed reduces the rate by 3/4 of a point, how long does that really take to work into the rest of the numbers, if you will? The effects for mortgages, everything.
It depends on how they did it. If it's 325 basis point cuts or 175 basis point cut has a very different approach. I don't expect the Fed would be doing any dramatic. I think they would spread it out. And then it'll be typically 18 to, well, cuts actually affect the other rates faster when you're raising rates slower. So you could see some move pretty quickly. But I think the problem on the mortgage rates is with an inverted yield curve, mortgage rates tend to be 175 to 200 basis points above the 10-year. I think right now they're probably, let's see, 7 to 10 years, they're probably closer to 300 basis points or 270. So I think I don't think mortgage rates will come down quite as much as everyone would hope. If the Fed starts to cut 3 times, I think it'll be a gradual come down for that. Other rates may come down faster, but I don't think mortgages will move quite as quickly. And then the rest of it bleeds through over 6 to 24 months.
Thank you.
I would not put a lot of stock in the Fed stimulating the economy too much right now. I think they're worried about cutting to overstimulate. So I think they're going to be hesitant to go the other way. I think they'll be hesitant to move and just keep it where it is where they prefer to be.
And Michael Daly?
Well, thanks, Mark, and thanks everybody for showing up. Stephen, I might have gotten distracted and missed the insight. The title of today's presentation, Inflation, the Last Mile. Did I get that right?
Yep.
It harkens me back a while where we were talking about transitory inflation. So here we are at the last mile. Could you help me understand, if I missed it, what?
The last mile is really getting it down to the 2% target that they've all had. So it's they use that similar to the last mile of logistics. But the idea is that the early stages of reducing inflation is easy. You cut rates, you get a pretty dramatic reflex. But to get the last bit of inflation out of the system, it's the most embedded inflation you have, and it just takes longer, and that's the fight. And they're worried about moving too soon or too late, because if you move too soon, you blow all the money you spent to get you here, and if you go too late, you don't have the firepower to get it back on track.
So, but I think to your earlier points about inflation versus cost of living, you know, the American consumer is left with food costs and other out of pocket that is just not going to deflate. It's I mean, the rate of inflation coming back to 2%, hey, that's great. But what we're left with is less buying power today for anyway.
Yeah, so your point is correct, Michael. You need to have higher wages to offset that. And I think people are going to be steadily looking for those higher wages, which is part of what the Fed's concern is about moving too soon to cut rates.
Yeah, but when you talk about wages, you know, you've mentioned now that airline workers several times and auto workers here and abroad. How broadly based are we going to see wage increases? It seems to me that most sectors do not have the bargaining power than the ones that you've called out for attention.
I don't agree. I think a lot of the labor shortages are giving the workers some real power to negotiate, either whether you're union or not. You're seeing a lot of areas. I think it's the industries that overhired over the last couple of years that you don't really have the negotiating power. But there's so many shortages of labor that is a problem still. So I think the real issue is going to come down to who can increase their productivity and maintain their margins. Those would be who wins in this environment. A lot of companies won't be able to.
Thank you. Thank
You're
you.
welcome.
Thank you, Stephen. My question is about how should we think about interest rates, economy, and the insurance industry. You touch on the insurance. It's going through the roof in condos everywhere else. So is the insurance industry affected by the cut rates, by the slow economy, or it just unsustainable or hardly sustainable in the climate change area?
Yes, I think you hit it. I think you hit on all their problems. They have an interest rate problem because they're, and for the most part, the general accounts of insurance companies are heavily invested in the fixed income markets or real estate. So their investment portfolios are struggling. And then when they went into the private sector, they were able to go into private investments. They probably got that at the wrong time. At the same time, their claims are going through the roof. And their risks are becoming much more difficult to ascertain from their tables, risk tables. So I think it's all those factors are coming into play. So it's a tough outlook. Makes it a hard area to invest in, and also creates some problems for other industries as well, like the housing industry in cities and states. So the ripple effect there is quite big.
Any other questions? Thinking about asking about Europe, since we have Europe sitting here. You want to just maybe make a comment on how Europe is coming along?
Inflation rates are going now down. In Germany, we are at 0.8%, which is much more lower than the interest rates are, which is good. The problem here is Germany is and France as well. We are going on strike. People are fighting for higher salaries. 10 to 12% is expected, and this will then over the year increase the price level a little bit. So it's expected that we end up at 2.5%, now at 3.5% inflation rate, but this is not dramatic. So it's doing well. The problem is that the economy for itself is not really growing. Expectation in Germany it's on 0.5%, which is below expectation, and this can cause a little bit of a smaller part of a recession, but not a real recession. So from that perspective, it's okay. The political situation in Europe is a little bit more unclear, as the alliance between Germany and the French people has been a little bit broken, as we have a very untrained political elite in Berlin. We are lacking on people who really can do that, or who can become someone who the people are following. The German chancellor is nobody in the world. So at the moment, Giorgina Meloni, the Italian minister president, it's ranked as the person who has the most power in Europe, which is interesting because Italy was in the past, Italy was also not respected, but Biden liked her. Biden supported her, and we will see what's coming up and how the development will go.
Yeah, I think the biggest problem Europe faces is an energy problem for a sustainable long-term energy solution. I mean, this is the intermediate term, not the long term.
This is in Germany. It's interesting. So we got a statistic that Germany will become carbon neutral in 2030. So in 2030 we will have more green energy produced than ever, and we can sustain with the renewable energy we have just brought in place. So this can also bring us to the point that we say, okay, the energy problem will change in 5 years' time.
It's the 5 years that
it's 5 years.
But I also think the other element that's missing with the energy policy is their industrial policy, that the Inflation Reduction Act and some of the other U.S. policies have left European companies at a huge disadvantage to where they are fleeing Europe to come here. Not a good setup.
Austin, I saw your hand up. You have a comment or question?
Yeah, Stephen, thanks for the presentation. You mentioned challenges in the housing industry. From my perspective, the high interest rates have created some great opportunities in commercial real estate. It's certainly very bullish on acquisitions in that sphere. Could you elaborate on the challenges you see?
In the housing market.
Yes, please.
Well, I think we're multiple challenges. We have a shortage problem that's, I think, 4+ million homes in the US. I think we have an affordability problem, and I think we have an income problem. Those who need the houses can't afford them. I think that's really a big part of what we have going, and it's getting harder and harder for the younger people to have a shot. And so a lot of the income is going to be, wealth is still going to be locked in, a very small percentage of people. So it's hard to have the economies do well when you have that kind of imbalance. So I think it's multiple issues with it.
So I certainly agree with all of that. But for me, the conclusion is then building affordable housing. It's a very good time to be building affordable housing.
With you on that. I'm not sure where the investments are yet in that area, but it's something I think it's a problem that needs to be solved. And when you have problems like that, they're usually opportunities.
Hey, Stephen, I was listening the other day in regards to affordable housing. These, what do they call? I don't even know what they call them, micro homes, but 400 to like 650 or 700 square feet. Those things are moving like any 2 or 3 different people that I've come across. They're moving really, really fast. What do you think the chances of extending that in a bigger way is?
I don't know if people are going to be rushing to those size homes, but I do think the era of McMansions is probably going away, or certainly slowing down. And I think the size of homes, the size of everything is going to be kind of getting more right-sized. And the younger people, the younger demographics certainly are not big on material items the way the boomer generation was. So I think you'll see things getting smaller and more utilitarian than they've been with the boomers.
But the
Adam
answer,
and then Amy.
Yes, thank you, Mark. My question is for Christoph regarding the energy consumption in Germany and the
Christoph.
renewables. Can you hear me?
Christoph or Michael?
Michael, sorry.
Because Christoph Oldenburg, I was like, is he here?
No, he's not here.
Sorry, Michael. That transition to carbon neutral and the greater consumption of renewables in Germany, what is the cost of that? Is that being subsidized by the government? Number one, my first question. Second question is, how much of that renewable is being used by industry as opposed to consumers? Europe's importing has really increased its LNG use or imports recently. So my question is, how real is that transition to renewables? And what is the cost of it? Who's paying for that?
In general, most of those things which are happening at the moment will be paid by private people. So we have some subsidies from the state to do this, from solar panels or wind turbines. And wind turbines are the most exciting part of that. The German government will give some subsidies on that, but it's not more higher than 30%, and the rest is completely private owned and financed. So when we're talking about, we have this great project we are talking tomorrow, Blue Tetris, which is here in the US. This is much more common in Europe, that we will build smaller power plants by combining solar panels from different households and use the energy to store that. We are much more ahead than each other country in the world in doing that. But this is really completely financed by the private households because they don't like to pay the high energy prices. This is every time in comparison. If you have high energy prices, the alternative cost in doing something for yourself, it's much more lower. Yeah. So I decided to do everything on my house and I have everything on my roof. I'm completely independent from the state energy prices because I'm producing more than we consume. Yeah, so we give some power to the grid. This happened with a lot of other people, and the transition it's ongoing. The only thing which is currently discussed in Germany is that we need a reserve of LNG and gas turbine power plants, which are owned by the government, just in case that we don't have wind, or we have some weather turbulences where we have peaks. And this will bring us to the point that we can use the energy completely for the industry as well as for the households. It's not only that we're looking still for energy which is consumed by the households. We are doing this exactly for getting also green energy for the industrial. The problem is the heavy consumption industries like chemical industries or steel industries, they will leave Germany. This is for sure, and this is happening at the moment because this is not competitive. And it's also calculated in that metrics that into 2023, some of them has gone. But then everything is fine, and it's really it's a mixture of subsidies, but most things are privately financed.
But they are going to move some of the subsidies from clean energy to the farmers, I was reading.
Oh yeah,
the farmers are getting screwed by the clean energy, so now they're moving the money over there.
Yeah.
I actually think the challenge is have limited fiscal space. There's only so many programs you can give away for people, and I think they're butting up against that while they're trying to raise their defense spending and whatnot at the same time.
Thank you, Michael.
Andy.
Stephen, back on the inflation and mortgage note, new applications for mortgages are still almost zero. It's very hard to finance construction, or it's expensive at least. How much do you think that the Fed is creating its own vicious cycle by keeping rates high because, the stock market's fine and unemployment's fine, but there's all kinds of other things that are problematic with a high real Fed funds rate. So essentially, the cost of housing is feeding into the inflation rate and making it more stubborn to come down. And that's also true for other things. Like, by the way, insurance risk is sold is that the risk-free interest rate is part of the input. So when the risk-free rate went from 0 to 5, that actually made the insurance cost go up. Just FYI. And so this circular, motion, smaller companies are actually going bankrupt. If you look at the Russell 2000, it's not making new highs. It goes on and on. So how much is the Fed, in your view, actually keeping inflation from coming down, costs up, by not lowering rates?
I'm not sure the Fed's, I don't know. I don't think if the Fed cut rates much, it would change the housing market materially. So I think Powell's said at his last press conference that the Fed's mandate isn't housing, it's price stability overall, and he's on a track to his target. So I think that's the way he's got to look at it. I think housing's a big part of the US market, but I don't think he's gearing himself towards that. I don't think he's flustered that up. I actually think it's just the economic conditions that we're faced with of the pandemic and the wars, and then the trade disruptions that he's adjusting to. So I don't think the Fed's the cause. And I don't think they're exacerbating it. I think they're just doing what they can against the environment that they're seeing. Reasonable people can disagree on that. But that's, I think, the way Powell's looked at it.
Fair enough.
Wanda, you have another question?
Yes, I'd like to follow briefly on Michael's comments about competitiveness of German industry and the industry leaving Germany. Michael, do you have any insights as to where that outflow goes? Is this the US? Is the US a beneficiary market, or other less costly, more competitive market?
In general, we have to say that the US is definitely fighting hard to get in this heavy heavy energy industry to the US. But if you have a look to other countries which are producing energy for much more lower cost, there are also tendencies, and Mark has been there, that Saudi is pushing to take it over and saying, okay, we do this here in Saudi. Yeah, so this is something where we definitely have to have a look at, because steel is not only consumed in Germany. Steel is a product which is consumed worldwide, and it doesn't matter if you produce it in the US, in Saudi, or in Europe. Yeah. The question is still where you have the lowest cost on that, and Saudi is definitely pushing this hard and trying to get an angle in that. We have seen a company which is called Outokumpu, which is a Finnish company, special steel manufacturer, and they closed the factory in Germany and they brought it completely to Saudi. But nevertheless, the US is also a very reasonable point where the blue manufacturing things are going to. Yeah, so this will change a lot of things in Germany, that we are losing blue collar works. At the end, it's a question if people will take care of that or not, because they're changing also the way they produce value for the country. Yeah, so US definitely it's doing hard. And the question is if you like to do that, to get this in the US every time.
Thank you.
Other comments, questions? Dipender, you want to share what you were seeing in India broadly, or what your impressions were of your trip?
Yeah, well, a couple of things. One, the main thing I focused on is this time is well, actually two things I looked at. One was real estate, and how the funding over there is quite different from how funding large projects here or in Europe is happening. And so I think there's if somebody can somehow hedge the rupee, that there may be a significant play there. But I'm sure smarter people than me have looked at it, but I don't see it happening yet. However, the other interesting thing is, in fact, I went to, I hope I'm not saying anything out of place, but I went to visit Payesh's incubator in Gurgaon. And that was kind of eye-opening also to me, because, basically the whole incubator that they have is only servicing US companies. All the companies that are being incubated, they're basically servicing US companies, and they're on US timeline as far as East Coast and West Coast. So that was a really interesting model. I've seen call centers and all of that stuff doing that, but this is really real developers, SaaS stuff, mostly in the education space. That was kind of pretty enlightening. I mean, his sister, as you probably know, Mark, has a venture fund that does this, and they actually built the building from ground up for this. So it's a major commitment. Majority of people think they're going to get it done in India by finding people there. She just rolled up her arms and went there for 3 years to do it. So, and once you do it like that, I was surprised also at the longevity of the engineers that had been at that company, some 7-10 years, which is kind of unheard of in India right now, because they're jumping ship right, left, and center. There's almost like a 50% attrition rate in the tech world over there.
So I think we're due to do another India deep dive.
Yeah, I think
actually we're due to go do a trip.
Yeah,
right?
So I've got that as far as I'm concerned, I've got the venue lined up. I've got we can invite people from, I think people for something like this will come from Mumbai, Bangalore, Pune, or whatever it is, because I try to look at some of the conferences that were going on there and met with a couple of people that organize that kind of stuff. I didn't see anything significant that was as open as what we do from a community point of view.
Right. Juan, is your hand back up or? Okay. Any other comments, questions?
I have a question about the energy, Michael. I can put some charts up if handy. What does Germany think about its energy policy in terms of costs related to its greenhouse gases? Germany produces 10 times the greenhouse gas as France, which of course is on nuclear, and Germany shut down nuclear. How much are they weighing cost versus actually, obviously being a green energy country?
It's a very good question. Yeah. So at the end, we have to say that the price level of the energy we're producing will be definitely higher than the other countries in the world. Yeah. So this is the outcome of everything what we do. Yeah. And this is something where the political elite at the moment, it's pushing this forward and saying, okay, we have to do this because we like to become the front runner in the world. Front running in the world doesn't mean that it's economically really rational. Yeah, and
Congratulations, you win.
yeah, but at the end, we will end up with we will stay with higher prices on energy, but we have a good mind in doing that. Yeah, so we like to save a little bit of the world in giving a showcase how you can do that. At the end, 20% to 30% higher prices is the expectation against nuclear power energy.
But what about defense spending with the potential scenario of Trump's in power?
Trump is not a respect in Germany. So, if Trump is coming in, there will be an alliance between the French and the Germans how to protect ourselves against any kind of policy which Trump might create.
So that's what it would take is a Trump election to get France and Germany to work together.
Yeah.
He'll take credit for that too.
He'll take credit. I can do that in one day.
But on the other side, yeah. So at the moment, there's a very interesting discussion about spending on defense. In Germany, we're now over 2.5% of the GDPR, and we are going above that. And there will be another step forward because the risk that Putin is doing something really crazy. Yeah, it's becoming higher and higher, and therefore we like to protect ourselves. And now the German army will be strengthened. We will hire another 50,000 people for the German army. There's ongoing things. The good thing is, if you're a private investor and you have invested in Rheinmetall, you will see there's the sharpest increase in stock prices we have ever seen. So since last September, higher than 50%, 80%. Yeah, this is amazing. But they are building, they are forcing to do everything, and there's not a single day in the last half a year that we're not talking about strengthening our defense industry. Right?
Except they're having trouble filling the army up because, as most countries are, the U.S. is too, because it's not a conscription army, right? So yeah, that issue. The other thing is they're starting to have policies now in Europe where half the defense spending has to be done on European defense companies.
Exactly.
Which is good for the European economy, but I'm not sure it's going to help get the munitions out as fast as they need to. So they get some challenge. That's going to be a challenge.